investing for beginners with these simple and timeless investment rules and strategies. Most people think that investing is picking the next great company or the next Tesla, the next Nvidia, but that is just not the case. If you are trying to do that, then you're just setting yourself up for failure. Let me show you over the next 10 minutes how to actually invest the smart way and how the top 1% invest their money. Whether you're a beginner or you're an experienced investor yourself, this video is going to resonate and you may learn one or two things. My name's Logan and I am a former financial advisor. And once I learned these tips, I really discovered that investing is actually so simple. Financial planning is so simple. We just never educate ourselves. And so that's why I've created these videos to help educate others on the basics and fundamentals of investment and financial planning. Timeless rule number one: time in the market beats time in the market every single time. When it comes to the stock market or the publicly traded markets, there are so many different variables that affect the ups and downs, and it is so hard to predict when there are going to be these large downs and these large ups, or these large dips and these large spikes. And I promise that by the time you're hearing the news or that your buddy is hearing about this great idea, it's probably already too late. Missing just a handful of the stock market's best performing days has a massive impact on your long-term returns. And this is what I mean. Using data from the S&P 500, if you were fully invested from 1990 to 2020 and you started with $10,000, that money would have grown to about $172,000. But if you were to miss the 10 best days, 24 hours, that same $10,000 would only be worth $87,000. That's pretty dramatic. If you were just not paying attention for those 10 days, if you would have sold or if you would have gotten out of the market and you would have missed 1, 2, 3, 4, 5, 6, 7, 8 of those days, if you missed the 20 best days, your return would have been $54,000. And if you would have missed the 30 best days, you would have only had about $35,000. And something to pay attention, or something that is very interesting with this as well, is that the best days are often clustered around some of the worst days when it comes to the stock market. And that's because markets rebound relatively quickly. And those rebounds are truly unpredictable about when they are going to actually happen. And so set it and forget it. Don't worry about it. Don't stress over it, because in the long run, you're going to be better off if you just set it and forget it. Investment rule number 2, diversification is crucial. When we talk about making money, or don't overlook diversification, and this is what I mean by diversification. I don't mean that you should have 50% stocks and 50% bonds. I am just clearly talking about stock market-based investing during this. What I am primarily talking about is so many people, so many financial gurus out there are saying, put all your money in the S&P 500, S&P 500, S&P 500. The S&P 500 is the 500 largest companies in the United States. This has nothing to do with any other companies in Europe, in South America, in Australia, you name it. That's all they're talking about. That's all that the S&P 500 is focused on. Now, over the last 20 years, the S&P 500 has dominated. So when I talk about diversification, we are only talking about stock market investing. And the reason why diversification is so important is because, quite honestly, it is so hard to predict who the next Tesla is going to be, who the next Nvidia is going to be. 5 years ago, nobody was talking about Nvidia. But if you would have been purchasing the S&P 500, every time you would have put money in, a little bit of it would have been going to Nvidia. So you still would have been able to capture a lot of that upside. And Nvidia has driven a lot of the growth that we have seen in the S&P 500 over the last few years. And so that's why I really like index funds, mutual funds, because they are an easy way to just diversify on autopilot and not have to overthink it, do a ton of research. You can simply choose certain indexes and you're going to get diversification with that. Now, within an index fund, all of these index funds are for different things. Your large cap index funds are your S&P 500. Your 500 largest companies in the United States. And then you're going to have international funds. And international funds are going to be your South America, Europe, Russia, China, you name it, outside of the United States, rocket science. And with international, you're going to have large cap, mid cap, small cap. Just think of it as large really well-known companies. Mid-cap, they're becoming bigger. And then small cap, they are very small. No one knows who they are yet. And so being able to have money in all these different sectors is just going to allow you to capitalize, because a lot of times when one goes up, one goes down. And so just having a well-diversified portfolio is going to, over the long run, produce a better long-term return. Now, over a 5-year, 10-year pocket, you probably would be better off putting all your money in one of them. But the question is, which one should you put your money into? Most people will say, put your money in the S&P 500. However, if you go look at the data, there have been times where international has outperformed the S&P 500. Now, over the last 20 years, S&P 500 has crushed it. And so I just think it's important to have a diversified portfolio with a majority or a good chunk in the S&P, a good majority or a good chunk in international companies, and keep it simple. The other reason I really like the mutual funds and the index funds is because there's a super cool and interesting statistic, but the average tenure of a company in the S&P 500 is just 18 years. And so 5 to 10% of the S&P 500 changes every single year. So you got to think about that. So many new companies are coming up and so many other companies are coming down. And so it's just really hard to predict. You don't have time. You have a full-time job. You have a family. You have a life. You don't have the time to be doing this research. Anyone can go look up the 5 to 10 biggest companies in the world right now and say, oh, that's where you should put your money. Now, you're right. Apple, Google, Microsoft, Tesla, Netflix, Amazon. Great. It's okay to have a little bit of money in these big players, but overall, you're going to get better long-term returns and less stress by investing in a diversified portfolio. And you might say Amazon's never going to go out of business. Tesla's never going to go out of business. But people said the same thing about all of these large corporations 20 years ago. You've got to remember the Blockbusters, the Kodaks, GE, some of these companies that we just never thought would go out of business. And they might not have gone out of business, but they haven't kept pace with these new technology stocks. And then soon we're going to have these more AI-based companies. And just the cycle is going to continue to repeat itself. The next investment tip is understanding taxes and how these work within the different accounts. Your retirement accounts are going to be taxed differently than a traditional brokerage taxable investment account. And so leverage those tax advantaged accounts so that way you can either get a tax deduction today or you can get tax-free growth for down the road. And if you're in your 20s or 30s and you can let money grow tax-free and never have to pay taxes on it again, that can be huge. You got to think of it. If you start putting in $500 to $600 a month into a Roth IRA every single year for the next 40 years, and that grows to be $1.5, $2 million, that is a very significant amount of money to where if it was in a taxable account, you're probably looking at taking 20 to 30% of that 1.5 million and paying that in taxes. The top 1%, don't panic sell. And this is what I mean. If you were to zoom in on the S&P 500, if you look at those dips, 2008, 2009, the Great Recession, when everyone lost their money, and you probably could ask your parents and they'll say, oh, I lost all this money, or my grandpa lost all this money. You zoom in, look at where we're at today. If you wouldn't have sold, you wouldn't have lost money. You only lose money if you sell. And that gets us to our next investment tip, which is don't invest money that you need in the next 2 to 3 to maybe even 5 years, depending on how aggressive or conservative your investment philosophy is. If you can't afford to leave it alone for at least 3 years, do not put that money in the stock market, because guess what? 4 out of 5 years, the market is positive and going up, but you don't want to put money in today. And then that's the year that the market goes down. It's just not worth it. And then I found that people that do this, they never get back in the stock market because they lost money that one time. No, you lost money because you were stupid and because you didn't plan, which is important to have an overall financial plan within your investment philosophy and plan. Chasing trends and meme stocks. This can be fun. You can make some quick cash, but it is not an investment strategy for building long-term durable wealth. If you want to do that, sports gambling is your option, or go to the casino. And then lastly, don't just take somebody's word for it. Don't just listen to some financial influencer like myself. Go learn this for yourself. Go talk to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 different people that are all successful in your eyes, and talk to some financial advisors, talk to some CPAs, talk to people that have done this and have experience doing it. If you follow these simple basic principles behind investing and you just keep these basic rules in mind, you're going to do better than 95% of people. And you're going to wake up in 20, 30, 40 years and you're going to be sitting pretty and you're going to be happy that you followed and subscribed to me. If you found any of these investment tips helpful, hit the subscribe button. Thanks for watching.